Now we're going to pivot to what's happening abroad. And one of the places that we always like to start with, just because of their importance to the market right now, is what's happening in Russia. And some like to say that the price cap is working. Look how good the price cap is. But as we've been showing, there was a big surge of buying in September, October, and November. And a lot of that was anticipation of the price cap, and again, there's also typically a lot of buying towards that period, and then you have a slowdown, and then you have that pickup as we go into the start of the year, and we're starting to see some of that now. Urals, free on board, which is just what FOB stands for. You can see just where January is versus the Brent side, and again, it's just going to stay there. We don't see too much upside at this point. You will get a bit more movement. Chinese and South Korean refiners have bought at least 10 Caspian CPC blend cargoes for February, even before the program's released. So again, you're starting to see some activity. You're starting to see some of that buying, and that normally is what happens in Feb. You have a really slow January because things slow down in December. Typically have a pretty weak Jan. And then you start to see that buying in Feb, because remember that it takes about 3 to 4 months for crude on a boat from the dock of loading to the gas tank, what have you, end user. It's 3 to 4 months on average, and that's just if things go as quickly as they could. So if you're buying in October, that's going to be consumption. If you think about November, December, January, if you're buying in November, you're starting to get an idea of that blend. Then you have that slowdown, and that slowdown in December and into January is right when you're in turnarounds. So you typically have some of that slowdown that is matched out. So it's not like, oh, look, things are look how well the price cap is doing. It's like, well, let's be realistic on when crude is purchased, how it's purchased, where it moves. So these are some of the key things that we're going to be watching going forward. CPC crude is largely stable at a discount of about 3 to 4 to dated Brent, which is stronger than -6 a month ago, which is what we've been saying. Like, differentials are starting to find some of that floor. It's still a bit cheaper, but again, you're starting to see some of that normalcy. But when we look at diesel, as we've been saying, diesel is surging in terms of a lot of these imports. Why? Because there's more than enough storage, and there's going to be a cap in February 5th. So what do? You buy as much as you can beforehand, and then figure it out afterwards. But you need some of this buffer zone in order to figure out ways to work around it, ways to address it, ways to essentially supplement or skirt the sanctions. So these are things that we expect to continue through January until we get that February 5th cutoff. Middle East crude, there were only 2 years that had more Middle East crude in floating storage. And this is what we've been saying, because if Saudi had cut OSPs to the U.S., that would have had a sizable driver for U.S. purchasing. And without it, we're not seeing a big purchase from Asia. Even as things start to get a bit back to normal with China reopening, there's a lot of free, let's call them, I'll call it free, but very discounted. I'm just saying I won't call it free. Very discounted Russian crude that China can purchase. You still have West Africa that's trying to be more aggressive. So I don't see a huge driver to go out and purchase Middle East crude. You're still not seeing those discounts that would incentivize additional purchases. U.S., this is a bit more of a makeup. When you look at the drop in exports, we still see it closer to about 3.7, 3.8 million barrels a day. And a lot of that is being supported by Europe, because realistically, that excess that was going to Asia has dropped off because of the OSP cuts. That is going to reduce the amount that Asia purchases from the U.S., but not so much China. It's South Korea, Japan, ASEAN nations. Those are the ones that are going to be purchasing more from Saudi, which is going to displace some of that excess crude that, let's call it 200 to 300,000 barrels a day, that was flowing from the U.S. into Asia. When you look at Dubai versus Brent, it's stabilized right at about $3.80. It's still not going to be enough at this point, given where Saudi is priced, in order to incentivize purchasing, especially when you're pricing it against Brent. Crude oil on the water, starting off the year with a bang, going back to 2016. It's not surprising to see us where it is, just because of where Russia is. And you can see the consistency between 2022, the green line, where that closed off and where we started. And just given where sanctions are, given where Russia is, this is going to remain the case, especially with the amount of crude that is not only in transit, but floating storage. In transit, starting off with a bang, right where we closed off the year in 2022. That's going to remain the case, just given where the flows are. Russia is continuing to push more into Asia. And then, seasonally speaking, you get the pickup as we go into February. So we are going to see a lot of support in the next, let's call it 3 months. Crude oil and floating storage, we're right at where we were in 2017, just below where we were in 2021. So still very much on the high end in terms of floating storage. And that's something that is going to continue, because there is a lot of crude in boats. There's a lot of crude that's sitting on the water, and there's just a lot of usage. And it's always going to come down to definitions. So floating storage is anything that has been stationary for 7 days, but it might move on the 10th. So it'll get calculated here, then go into transit. So that's why we talk about these so much, because you have to look at both of them together to a point to understand the full dynamics and play. And I think a key focal point now, following what's happened with Russia, more crude is going to be on the water. So we want to look at how is that impacting that land storage front. Asian floating storage starting off just above where we were in 2022. Again, as we said last week, we thought it was going to close right around 2021 levels, right on the nose, starting right just above where we were in 2022. Going to remain elevated, especially because we did have a surge of buying from China as we really October into late November, early December, and those cargoes are going to show up, and that's going to go into that floating storage side. And here you can see just how, as we were saying for 2022, you can see from the beginning of October, you had a big surge. You had record-setting buying, or at least supertanker imports, dropped off in December, and now you're going to start off fairly slow because you have a lot of wood to chop based on what you're taking delivery on. And you want to try to time it with some of those reopenings. They've increased the import quotas. That's going to open up their ability to bring in more. As we said last week, they increased the export quotas. So now you're going to see China importing more crude, which they can based on what they purchased, but also exporting more product. So as that happens, you're going to take away some of that crude from other Asian markets, but that's not a terrible thing, because you're going to reduce the value of their refined products based on Chinese exports. So that's when you could start seeing some of those economic run cuts that could start to hit Singapore, Malaysia, and South Korea. So then when we start looking at runs in Shandong, here you can see that they started off a bit weaker at about 66% utilization rate. We do see that creeping up to the high side. Seasonally speaking, we're right where we were on the average, right where we were in 2022. But we do see that trending up in the short term. So then when you look at West Africa, fairly just above average. We do see, as we were saying, they got more aggressive with some of their purchasing, with some of their pricing. India just bought a slug from Nigeria. I think it was 10 million barrels, just in terms of where some of the flows are. That'll help support some of those different movements. And now Nigeria is talking about trying to get their production back to the levels that they were at previously of about 2.2 million barrels a day. This is where it's going to be interesting to see, can they do it? Or has there been enough degradation? Has there been enough drop in the source rock to be able to achieve that? And that's going to be an interesting tell for this year when you start looking at Nigerian activity and because if Nigeria really can't get back to those levels, and I think 2.2 would be a bit aggressive to get to, not only just based on what the market will bear, but also from their production side, that'll give some credence to is spare capacity really where they say it is? Or is there, can we take this and extrapolate out and see some of those slowdowns on the buying front? So then when you look at product exports here, you can see finished gasoline was down 190,000 barrels on the export side from the U.S., still well above the 5-year average. That's going to stay fairly stable. Distillate had a big drop of 468,000 barrels a day, just below the 5-year. We think it's going to kind of hang just around the 5-year, given what the timing is of what Europe does from Russia versus buying from the U.S. Propane, propylene staying very strong, up another 228,000 barrels a day, well above the 5-year, going to continue to be strong just because there's not as much product coming from the Middle East, and we're still priced to sell. Given the lack of demand internally, this turns around and goes abroad. Crude oil exports had a big drop of over 2 million barrels a day. Some of that is timing, some of that is weather. Again, we still have this averaging out at about 3.7, 3.8 million barrels a day. Here's your gasoline sitting at the highs. We see it staying at the highs here and still remaining fairly strong, well over the 5-year average. Distillate, as we were saying, it's going to stay just below or right at the 5-year average. And the headwinds is going to be just obviously the demand going into Europe and the Atlantic Basin. Crude oil exports starting off weaker, but again, a lot of that is semantics and timing. We still have that being fairly strong. Propane, propylene starting the year off with a bang. It's going to continue to be the case just because pricing is low, because of lack of internal demand, going to free up opportunities to go abroad. Now, when we look at Fujairah had a draw of 510,000 barrels, bringing us at about 19.839 million barrels in storage. Stock movements, were slight almost across the board. Light distillate had a build of 192,000 barrels a day to be just over 7 million. East of Suez gasoline complex strengthened a bit as some markets adjusted with Chinese gasoline exports in January to drop on the back of stronger demand ahead of obviously Lunar New Year. Because remember, it picks up in it starts January 18th. But then when you look at Chinese exports will decrease as COVID-19 cases remain fairly high. So that's where you're going to kind of get that back and forth in terms of where's China going to be on the reopening. We think Lunar New Year is going to disappoint just because people are still contagious, people are still getting it. And a lot of times Lunar New Year is when you go home to visit your family, and if you have elderly grandparents, aunts, uncles, you'll try to avoid that spread. So we do see some of that slowdown in internal demand, which is going to increase the amount of exports, which will put pressure on the global market, especially when you look at the Asia and Fujairah side as that knock-on effect continues. Middle distillate had a drop of 358,000 barrels, coming in at 2.761 million. East of Suez gas oil, but then the East of Suez gas oil market was a bit softer. As the Lunar New Year holiday, there's typically a bit of a push to get the product out ahead of schedule before people go on vacation from China. And again, you get off. So even if you don't go away, it'd be a bit of a staycation, though people have been locked in their homes, may not want to stay home. But when you start looking west, markets you sees a improving demand in European gas oil markets with the EU sanctions on Russia. So that's where you're going to see this storage remain low, and that's going to support that crack spread on the middle distillate side, which is an important thing to watch when you start looking at the economics of Asian refining, Middle Eastern refining in general. Heavy resid fell 344,000 barrels to just over 10 million. Spot trading activity was picked up a bit ahead of flat pricing, but again, we don't see too much of an increase just given the headwinds that we've been talking about at the Econ show on the trading on trade flows and underlying economic growth. Time spread, you still are in contango when you look at March, April. As we've been saying, we do expect more strength in demand from an April-May perspective. So it makes sense to store now, sell later, and that's where you're pricing in some of those economics. When we look at flows, so Norway had a bit of a hiccup with a power loss, so that slowed down some exports, some production, but exports based on where we are shouldn't impact things too much. Nigeria, remember, they want to increase production by 1 million barrels a day, essentially. Can they do it? And this is going to be an important piece, because even at producing or exporting at 1.28 million, they're struggling to sell their crude. Now it's picked up a bit, and if that remains, well, maybe it makes sense to go back to 1.4, 1.5 million barrels a day of exports. So that'll be one to watch that I think is going to be important. Angola continuing to be similar. And then when you look at pricing, Vital offered 650,000 barrels of brass for at $6.40 more than dated Brent. And that's, again, but they've withdrawn some cargoes that were right around $6. So I think they're trying to figure out that right price. Then when you look at the IOC, closed a tender to purchase West African crude for March 1st to 10th. Just in terms of where that is. Nigeria sees oil production reaching 2.2 million barrels a day. I question some of that, but we'll see. So the quote was, we see a trajectory of restoring production, including condensate within the year. Definitely, we believe we can hit a target of 2.2 million barrels a day, but our budget target is 1.8. But we know that it is practical to do 2.2 within 2023. So 1.8, I think, is more realistic. If anything, I would say it's probably closer to 1.6. But if we get a sizable demand increase, which I don't think we do because of economic weakness on the crude demand side, that'll be an important one to watch. And then the West African sales for crude for loading next month have increased in recent days, which is why we're starting to see a bit of firming when you look at some of the differentials. When we look at Europe, we're starting out at a fairly high end on the crude side in terms of storage, but fairly in line with where we closed the year on 2022. So just based on some of the dynamics, we did get some additional refinery slowdowns and refinery utilization rates coming down a bit, which should put a bit more crude in storage. Here you can see that there were builds pretty much across the board on the refined product side. And then when you look at gas oil, we're tracking right where we were, let's just say just below where we were in 2022. And as the rush is to fill this up, we're going to continue to see the builds because demand has been fairly slow, especially when you look at heating needs. Heating, it's gotten a bit colder in some areas, but you still had some decent warm weather. It's actually starting to, every run of the European model is showing a colder January. So that's going to be important to watch and see how it offsets some of these additional imports. When you look at gasoline, all-time highs, again, it's just there's not as much driving. And because of the dynamics in the shipping world, the ARB is very difficult to see it come from Europe into the U.S., and that's going to remain the case, again, keeping things fairly elevated. Fuel oil on the higher side, that's going to remain until they can ship it into Asia. The problem is Russia's dumping a ton of fuel oil into the market, into both the Middle East as well as Asia, which is going to keep this fuel oil capped in Europe. When you look at Singapore, small build, it was went from 45.3 to 45.9. But when you look at it, it's very much at the higher end. The only time we were really higher was 2021. So you're still starting off elevated, which is why we see some friction with where this demand is going to come from for product as China puts more product into the market. We do expect to see a bit of pressure on refinery runs, refinery activity, which is why Saudi cut OSPs into Asia, trying to give some of that buffer, and that's going to be an important thing to watch here. Light distillate, again, record high, which is there's not a huge demand of gasoline. And when you make diesel, you inherently throw off gasoline, and this is going to continue to be a problem because this puts pressure on the overall crack spread or the value of a refinery utilization rate. Because as diesel prices are strong, that how strong do they have to be to support something that is going to be this weak? And here you can see diesel a bit higher than where we were to close out the year of 2022. But again, you could see still on the low end with a lot of you could see this get a bit more bearish in terms of storage, where storage is going to elevate. It's all going to depend on how quickly some of this Chinese product gets to the market. And if it does, and if this storage goes up, given where gasoline is, that's going to hurt crack spreads. And again, that's why we talk so much about the potential for refinery utilization cuts in the area. And then when you look at resid, again, still starting at the high end, and we don't see that changing given the amount of Russian product coming through. North Sea storage, just below average. We don't see this adjusting too much because of some of the hiccups, depending on how quickly they fix the power outage. You could see this drop just a bit, but again, nothing too crazy here. And then on the European front, you can see that we're fairly at the high end, and we're actually right where we were in 2021. That's why we do see some of that flows coming from floating into onshore. So we do see some decent builds on European crude because we've had refiners come down a bit and we have excess floating storage. So again, kind of that balancing act. So that's what we have for you today. If you have any questions, please feel free to reach out, whether it's the comment section, Twitter, and then next week we'll get back to it with the Econ show, EIA show, and I will be back for the frac spread show next week. I have to be in the city tomorrow, so you're going to have Matt again. So hopefully you enjoy, and we hope you have a great weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.